Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is January 29th. This is host Richard Benuli. Today we have a very special show for you, a reconvening of the four horsemen. We have all met together a few times, including just before the onset of the COVID pandemic and the beginning of the lockdowns. And the four horsemen are David Rosenberg, Jim Bianco, Peter Boockvar, and Ira Harris. David founded his own firm, Rosenberg Research, after being chief economist strategist at Busk and Sheff. The firm offers extensive research and information services with a trial service that we can post a link up to on our website. And he's also served as the chief economist for Merrill Lynch, one of the 12 smartest people on Wall Street by Business Insider. Jim is president of Bianco Research LLC. Since November 1990, he's been producing fixed income commentaries with a circulation of hundreds of portfolio managers and traders. He's regularly featured on several media outlets, including the Wall Street Journal, New York Times, Barron's, Business Week, Forbes, Fortune, CNBC, CNN, Bloomberg, and Fox. Peter's chief investment officer for the Bleakley Financial Group and Advisory. He has a newsletter product called the Book Report on a Substack platform. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. And Ira's independent trader, past hedge fund manager, and global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and a stint most recently. Welcome, gentlemen.
Thanks for having us.
Thanks, Richard.
Great. I thought we'd begin with a commentary on the global macro view on the economy and the financial markets. David, did you want to give your thoughts?
Well, sure. You want to talk about the global economy, and it's hardly homogeneous. We have globally very uneven growth. You've got, within Asia, what's most important is Chinese economy, which continues to grapple with its excess capacity in manufacturing and the aftershocks of the meltdown in its property market and all the aftershocks. And the fact that, the Chinese benchmark bond yields are trading at historic lows tells you something about what the macro outlook is in the world's second largest economy, with obvious repercussions throughout the continent. Japan is probably doing well for an economy that's been moribund for the better part of the past 3 or 4 decades, but economic growth there is still pretty feeble, even with monetary policy conditions between the level of interest rates, real rates, and the super weak Japanese yen. You would think that even with their declining population base, their economy should be doing a lot better, but it's just trudging along. And then you have, a country like Canada, the 51st state, as Donald Trump likes to call it, which we all know is the 51st state in any event, is seeing its real GDP decline in per capita terms now for 7 quarters in a row. And of course, the Bank of Canada cut interest rates today. And not just in relation to what the economy north of the border is doing and inflation, but also with respect to the Trump tariff threat, which we'll see this weekend if it morphs into reality. And as the pendulum swings on this file, it looks like that him and Scott Bessent, quite disappointingly, are going to be moving towards the broad-based tariff. The question is, will it be as pernicious as 25%? The only economy that has any vibrancy to it is the U.S. The year-over-year trend in real GDP is 2.7%. I guess these days that's labeled as a boom. We can question whether or not that's above or below or in line with potential. But the one thing I'll say about America and U.S. exceptionalism is what's causing U.S. economic growth to really stand out, over and beyond what's happened with R&D spending and the technology boom related to generative AI. And that really is a two-bit player to really what the story has been for the U.S. economy, which has surprised me, which is the elongated fiscal policy cycle, which has transcended COVID and the after effects of COVID. And here we are heading into 3 years in a row where the U.S. fiscal deficit is over 6% of GDP. That's double the average for the rest of the OECD. In Canada, the deficit is 2% of GDP, and people in Canada think that the deficit here is too high. But half the growth in the United States has come from tax subsidies and double-digit growth in government spending. So the day that the fiscal spigots run their course, if they ever do, I think that the emperor will be disrobed. But that is really what I think about the global economy is that it is mixed, uneven, and the U.S. has been the bastion of growth. But I would say that it reminds me of a Potemkin village where the growth is being influenced principally by the ongoing generosity and deep wallet of Uncle Sam. All I can say before I hand it off is that this is a year of tremendous uncertainty. When you ask me, and of course, it's always the case that things are uncertain, but this is a level of uncertainty that is a 2 to 3 standard deviation event from what we've been accustomed to in the past 60 or 70 years. This is Trump 1.0 on steroids. And between fiscal, trade, and immigration policy, the impact it has on growth and on inflation is highly uncertain. And when Jay Powell says that this is akin to walking in the dark, and when you walk in the dark, you basically go slow. And the principal reason why the Fed is on hold now indefinitely is because they don't really know what's going to happen. It's very difficult for people like me, economic prognosticators, to really come up with a forecast of anything right now that you can be reasonably comfortable with. It's a very uneasy and uncomfortable position to be in if you're a forecaster, and I sympathize with Jay Powell and his brethren at the Fed. But the one thing I know about financial markets is that when there is elevated and rising uncertainty, that should be reflected in risk premia across all asset classes. The Treasury market has already corrected hard, and it's been more due to the term premium, which is the poster child for uncertainty, rather than any incipient inflationary pressures or expectations. And then the question is going to be, with a lag, how this ultimately influences the stock market, which still trades with a 22 multiple or a 37 Kate multiple, which is a 2.3 sigma event. So this is a situation where, the Fed is paying you to be in cash. I think there's probably some parts of the fixed income market that look very attractive in terms of yield. But I think a much more selective financial market landscape globally than we've seen in the past. I think the only real significant bet we can make is that other central banks will be cutting rates. The ECB tomorrow, the Bank of Canada today, the BOE, now the Reserve Bank of Australia will start to embark on its easing campaign, and the Fed will be on hold. And so no matter what, these interest rate differentials will put upward pressure on the U.S. dollar. So I would say that you want to be in high-yielding countries. The U.S. is a high-yielding country, and in a country with a strong currency. And the one thing I think we can say with reasonable confidence is that the U.S. dollar's bull market probably remains intact until such time as the uncertainty lifts and the Fed feels more confident in re-embarking on its interest rate cuts.
Peter, do you see the same factors and trends? What are your thoughts on the global macro view?
No, I pretty much agree with everything David said. I'll just add a couple of things. Uh, in, David talked about the 2.7% headline GDP, and there are people out there that they look at that and they say, the U.S. economy is solid. It's hitting on all cylinders, and it's far from that. David highlighted the bright spots. I'll also add, upper income spending, people benefiting from the stock market, the value of their home, which is up 50% over the past 5 years. There's definitely a wealth effect that's flowing through. And you hear from the airlines, you hear from Royal Caribbean yesterday about their business. Spending on still experiences is still a vibrant part of the economy. But on the flip side, there's some real drags. I mean, you got a 30-year low in the pace of existing home sales. And when you think about all the ancillary activities that don't take place when you don't turn over a home, you can understand why Home Depot's business is not seeing really much in comp growth. If you're making flooring or carpet or paint, you're really not seeing any growth. And you take the U.S. housing market in totality, according to the NAHB, you're talking to about 15 to 18% of the U.S. economy. And even on the new build side, which is doing better, a lot of that is bigger builders that are taking share from smaller ones and providing a lot of discounts in order to drive product. We know manufacturing has been in a recession for 2+ years. It's been that way globally. Global trade has been, somewhat muted, depending on who you are. It's been vibrant for China, but not so much for others. And then you take out the spend on AI and capital spending overall outside, and not just AI, but all the data center spillovers. You're talking about electrical equipment and cement and steel and so on. CapEx X this stuff is actually pretty flattish. So to David's point, I'm seeing the same thing, a very mixed and uneven, not just domestic economy, but globally too. And you take Europe, Germany is essentially flatlining. France is struggling, but UK is doing a little better. And Spain has actually been a bright spot within the European economy, as has Italy, relative to their historical growth rates. So it's a really confusing story at the same time too, with so many different cross currents. And to highlight, David mentioned Jay Powell and what he's looking at. Powell talks about the strong economy, but then his own team of districts that gives him the beige book every, call it 6 weeks, telling him that growth is very little. So that adds to the confusion, is that he reads the beige book and it says, okay, well, most districts are seeing little growth. Some districts are seeing no growth. Maybe 1 or 2 districts are seeing contraction. Like, my head would spin too if I read that, but then saw other things. And lastly, and I'll pass it to you, to Jim, on the labor market, it's mixed there. A lot of things that I look at, whether it's the hiring rate, the quit rate, continuing claims, the labor market hiring is definitely slower than it was in 2023. But the pace of firings, based on just looking at claims, it's pretty low. So companies are still reluctant to lay people off and holding on to their best workers. So that in itself is mixed and uneven within the labor market. So a lot of confusing, mixed, uneven factors that lead to an overall confusing picture.
Yeah, go ahead, Jim. Your thoughts on the global macro view? You see perspective similar to Peter and David?
Yeah, I agree with most of what they said. So instead of repeating that, I'll just add a little bit more to it. Going back to what David said, we used to use this phrase before the pandemic called global synchronized growth, or coordination among central banks. And we don't have that post-pandemic. We have economies going left, right, and center all the time. And so that has been a little bit unusual to basically we cannot make blanket statements anymore about what is the state of global growth. We have to do as David did. We have to break it down country by country or region by region, because they're all going in different places. And then to add what Peter said, after you've broken it down by country, then you have to go into the country and talk about how the growth is very uneven within the country as well. So that is something that has been a little bit new. If I was to add something more to the conversation, it would probably be on financial markets and about on the concentration in financial markets. That is also unusual because of the dominance of AI, because of the dominance of a handful of players. We've got now 34% or 33% of the S&P 500 made up by the Mag 7 stocks, and they're being, roiled. Those stocks are being roiled by the prospects of competition because of cheaper cost due to this DeepSeek AI that came out in the last week or so. That's also impacting the global stock markets because 60% of the global stock market index is the U.S. and 25% of the global stock market index is these 7 companies. So we can go through what the economy is doing, what's going on within the economy, what inflation's doing, and then all we need is somebody to just say, I got a better mousetrap in terms of AI, and it roils markets because these companies are so big and they're so dominant. And it may not have anything to do with the economics of what happened. Has the economy fundamentally changed since Friday? No, it has not. But possibly the business outlook for the Mag 7 stocks has, and that means every investor is going to feel it. Even in the bond market, you're going to feel it as well, too, because you saw a big rally out of bonds.
Yeah, great comments and observations on the concentration risk. What are your thoughts, Ira?
Well, again, I'm going to follow with everybody else. There's so much here that I agree with, but then we have to start looking at other places because this is going to be, as David laid out, and we all agree. I would say a phenomenally volatile year because there's so many things in play and so many things that we don't know. And we have a Secretary of Treasury, Scott Bessent, who comes, I would say, from our realm. He's truly a global macro guy. He thinks in a global macro setting. So we should certainly see, I think, some real creativity. It doesn't mean that it's going to be successful, but it's going to be creative. And we're going to see things out of a U.S. Treasurer, out of a Secretary of Treasury we haven't seen, I would probably argue, since Jim Baker. And Baker wasn't an economic guy. He was a globalist who understood certainly global politics and knew how to use American strength to try to get what he wants and try to get what they needed, really more than what they wanted, and understood that America was being hollowed out because the overly strong dollar, as Volcker found his inner Volcker. And we had all those types of situations. So that's going to make it even more so. And if I can, tongue in cheek, we saw Japan, we saw Canada cut today, and I know that was widely expected, and I hope David will talk more about that. And I know that when I read what the Mecklen had to say about the tariffs, but this Canadian dollar is so cheap. And some people want to say it's because of the tariffs. I'm not trying to get David and Richard in trouble, but I would probably say more because of political leadership, because the Canadian dollar has fallen 18% since 2021 for various reasons. But we also had Japan last week, and Japan raised, but I thought it was a tepid raise. Because they keep talking about, there was a speech given by Himino Ryozo in which he spent, it was a 14-page speech, 4 pages were discussing real yields. And real yields in Japan are negative. And it's leading them into a bad situation again. First of all, the yen is too cheap. So I'm going to wait to hear Scott Bessent finally come in. I don't think they're going to tariff Japan, but I think they'll be talking about the currency. At some point, don't know when, and if you can't raise in these tepid, the Greenspan methodology, or as Dennis Gartman used to call it, coffee spoon by coffee spoon of 25 basis points. Japan needs to go more. in order to get ahead of it. Otherwise, you're going to come and intervene on the yen, on dollar yen again, and you're going to burn up money. So either way, it's going to cost you. And the JGBs have already told the Japanese, you got to get moving here because you're paying for that money anyway. And as I read what Ueda had to say, Richard, I'm gonna defer to you because tongue in cheek, I'm gonna say this because when I look at the G30 and I look at people like Ueda, all PhDs out of MIT, and they have a tepid approach, I have to ask, in order to qualify for a PhD at MIT, do you have to become a eunuch? Richard, I know you come from MIT, so you'll probably be able to answer that question because they really proceed so slowly. And that's where I'm going to end because I know we'll pick up from there, but that's the global situation.
No, that's good comments. And actually further to your comment about the creative development by U.S. Secretary of the Treasury, Scott Bessent, and, in terms of that he may be targeting a goal to weaken the U.S. dollar, as well as U.S. President Donald Trump targeting goals to reduce interest rates and to reduce the price of oil, energy, electricity by 50% within 1 year. How will they attempt to do this is the question. And what will be the effects on the economy and the financial markets, considering that this could also make U.S. assets, treasuries, equities lower value from an international perspective. So your thoughts on that, David, for creative development?
Well, the problem is that it's next to impossible for Trump to achieve all those objectives because he's injected fiscal uncertainty and he wants to impose tariffs, and at the same time he wants a lower dollar and lower interest rates, and they just don't fit into the puzzle. That's the problem. You can't have all those things happen at the same time. So the bottom line is that he'll jawbone the Fed, but as we saw in 2018, Powell didn't just stay on the sidelines. He raised rates 4 times, and Powell's got a year left, and he wants to preserve his legacy, and especially after the horrible inflationary experience that he presided over, he's not going to take any risks on the inflation side. And as we saw with the Bank Canada today, which was all about tariffs, you can argue it cuts both ways, and you can argue that it's a one-time price level adjustment. But the difference in the United States is that tariffs at a time of, call it a fully employed economy, roughly 4% unemployment, what's on the Fed's mind where we are in the business cycle is whether that will lead to a second round impact on wages. So Powell's not going to be in any big hurry to cut interest rates unless the economy really rolls over. And at this point, they won't have enough information until the second half of the year to do anything. So the Fed's not cutting rates. You'd have to have really sustained weakness in the economy. And we'll see how the data play out, but that would be the base case. The view that drill, baby, drill, well, here's the problem. There's 2 of them. The first is that the CEOs of the major E&P companies in the U.S. have already said they're not going to be drilling for a lot of oil. Trump doesn't drill oil. He can jawbone the industry, but they've already said that they don't actually have, at this point, very ambitious capital spending plans. So I'm looking at that drill, baby, drill is just pure rhetoric. I don't think that's what's going to bring oil prices down. It sounds good. Bessent's 333 is really very clever, but it's just a colloquial term. 333, it sounds nice. the other problem is the tariffs. How on earth will Donald Trump bring oil prices down if he imposes a 25% tariff on Canada, and then Canada responds with, say, an export tax on energy? I mean, Canada has some choices to make if it gets hit by a tariff. And if it wants to respond, which there's a groundswell of support that Canada should respond, well, what does Canada sell into the U.S. that the U.S. needs, especially in the wintertime? Electricity, natural gas, and oil. And over half of U.S. oil import needs actually come from Canada. So if Canada responds to the tariff, you're going to see oil prices go up. You're not seeing oil prices go down. Okay, so there's just everything that we're talking about here that Trump wants to accomplish, it's just not going to work out. And then if you get higher oil prices, and then that's going to feed into headline inflation and inflation expectations. And so how are interest rates going to come down? And of course, Trump tells everybody that he knows interest rates better than anybody. And I don't even know how that's even possible. He might not. He might know from his private sector experience how to load up on debt, and in some cases how to be foreclosed on. Although he didn't really have to ever pay any price in that because he had no equity in the business. But he doesn't really know a whole lot about interest rates, except that he is a real estate guy who loves low interest rates. But that's just not going to happen. And then to suggest that you're going to tell me that Scott Bessent wants a weaker dollar, well, that just flies into everything in economic theory and practice, that the country that imposes the tariff is the country ipso facto that experiences the strengthening currency. So do you see everything that we're being told, which sounds very nice? Maybe we'll also end up having root beer in the water fountain in every high school in the United States. There's nothing here that actually is consistent with each other. And hence why there's so much uncertainty. And it's funny that the uncertainty that gripped the stock market was an event that happened out of China. Because when you look at the market multiple in the United States, and you look at the equity risk premium, I mean, you've got a stock market that's trading as though the real rate is still negative. No, but the real rate is over 2%. So you have a very big mismatch. The bond market's already gone through its coronary in the past several months. And the question is, what's the lag for the stock market? But in answer to your question, between oil, between the dollar, between interest rates, and all the things that Trump is saying he wants to have, he would really have to turn around the laws of nature, make all those things happen simultaneously.
And
David,
Peter, what are your thoughts on
can
that?
I ask you a question?
Okay.
Which do you like better, 333 or Herman Cain's old 999?
What was it? What was that, Jerry?
Well,
Remember, Herman Cain used to have his 999 plan, and now we've got Bessent with 333. Which one did you like better?
I wouldn't mind the 333, but the policy pledges in place are incongruent with that. So there's just this mutual inconsistency. But I love the 333 is great. It's great. And it sounds great. It's a great soundbite. But that's all it is. But if that's what we got in the end, sure, bring it on.
Meet the Cedar Owl, a new economics and finance publication with a focus on environmentalism. We combine the Austrian School of Economics and market environmentalism principles for investing in a sustainable future. Follow the link in the description to get to know the Cedar Owl better, understand our values, our mission, exactly where we're coming from, and the type of content that we release on a cyclical basis every Thursday. Join us in targeting outperforming portfolio returns while making a positive impact on society and the environment through technology. Subscribe now for weekly insights, investment articles, and exclusive content.
Richard, I want to ask David a question, because he's been totally right about the Canadian dollar over the last, I would say, 18 months for sure. And the Canadian dollar has been very weak. at what point, David, do Canadian energy companies become really attractive to global buyers? Because, I mean, we go back to 2007 and 2011, when the Canadian dollar was uber strong. And I sit here in a community in Arizona where all these Canadians were busy buying U.S. property up with their strong currency, which of course is one of the great ways to play a strong currency. At what point is the Canadian dollar too weak, and is there anything that can be done to strengthen it?
Well, I mean, you can actually argue that right now, but Canada right now, it's call it 144 on its way to 145, is for sale. But I doubt that there's going to be a bid so long as there's a risk of a prolonged and protracted trade war with a country that is your chief trading partner. And Canada, remember, ships more than 20% of its GDP south of the border. So the problem is that for sale sign, yes, attractive, yes, but there's just too much uncertainty. Too much uncertainty globally, but a lot of uncertainty in Canada. And then if Canada reacts to Trump, how will Trump react back to Canada? It's really very difficult to believe this is happening with your strongest ally. Canadians are dumbfounded and very surprised. Most of my clients are actually in the States, and when I talk about this in my daily, I get back from most Americans, Canada is just a bunch of crybabies and parasites. So I don't know why there's so much public support for this sort of tariff action to Canada. Canada, 1% of the fentanyl coming into the U.S. Illegally from foreign sources, 1% of it comes from Canada. Meanwhile, 90% of the illegal firearms in Canada come from the U.S. But it's a, who knows why Trump is attacking Canada, to tell you the truth, unless it's maybe a surreptitious way to show to China, if this is what we do to our friends, look at what we'll do to you. I'm not really sure. This 25% tariff, and look, he puts it on against Mexico. The U.S., half of its imports of food come from Mexico. So, and then we don't know how Mexico is going to react, but you're going to have a very pernicious inflationary tax increase on food and energy. And then I think, when does Canada become a buy? Is when all this uncertainty dissipates, when Trump relents, when this trade war ends. Canada, I think that foreign investors will be coming into Canada, as you said, in droves. The question is, at what level Canadian dollar are we talking about? And it's situational, because when you're talking about these tariffs, they're so big that they would have it would hit the Canadian economy. Real GDP would go down by 2%. Which people say, whoa, 2%, big deal. Well, GDP is not the NASDAQ 100. A 2% decline in a slow-moving animal like real GDP is like a 30% decline in the stock market. It'd be as big a recession as we had in the early 90s and the early 80s in Canada. And if we get that and you map that through to what the Bank Canada would have to do to offset that through rates and maybe through a resumption of QE, and where interest rate differentials will go vis-a-vis the U.S., you could see the Canadian dollar getting back to where it was in 2002 when it got to 160. Now, I think that would be a dramatic overshoot, but that's, I think, a plausible scenario. Now, it gets to that level, and something happens that causes the trade frictions to end. Well, then we'll see a reversal in that, and the Canadian dollar will rally, and of course, the for sale sign will attract a lot of bids. Right now, the bids aren't there, so we really have to see this uncertainty dissipate. And until it does, the path of least resistance is going to be ongoing Canadian dollar depreciation.
Jump in and a couple of quick comments. two. If first on what David said, first a more recent comment. David, you can respond maybe if you want, but I kind of saw Trump as basically trolling Trudeau. He doesn't like Trudeau, which is why he kept calling him the governor of Canada and talking about taking over the country. And my take is when Pierre becomes the PM, he's going to change his tune. And I would also throw in, too, that if Carney does become the head of the Liberal Party in the next PM, Trump is going to, ratchet up his trolling on Carney and about taking over Canada even more. But before you answer that, let me jump into my other comment. Peter and I were at an investment conference this past weekend. Zoltan Spolzar spoke there. I'm not going to go through the details, but he talked about restructuring the U.S. Treasury debt. And the reason I don't want to go through the details is I don't think the details matter as much as what David said. Also, that Scott Bessent could be as consequential as Jim Baker. I think he could be more consequential than Jim Baker. I think that what we should expect, and this is what Zoltan was talking about with restructuring the debt, is their plan is not to take over Panama and Greenland and, do some deportations and then play 3 years of golf. They're going to keep going and going with bold initiative plans. And one of those plans I think that's high on Scott Bessent's list is what to do about $37 trillion of debt and about tremendous government spending. Well, DOGE is supposed to be one possibility to rein in government spending. We'll see if it's successful. My take on that real quick is you don't need Elon. The four of us could get together in a day and a half and figure out how to get rid of $2 trillion out of the government's budget. The problem is getting Congress to agree to it. That's going to be the difficulty with that program. But then the other thing is a potential on restructuring of the debt. Whether or not they do something on that side. But I think the takeaway I would want to leave people with is think bold, because the plan here is to be bold, bolder, and boldest. And I think when we talked about earlier, this unusual level of uncertainty that we see in the markets, that's because we know that there's going to be big, bold plans that have never been tried before. And to some extent, you're starting to get people to sign up on it. Last week, Jamie Dimon spoke about tariffs, and his attitude was, yeah, the tariffs are going to come, but Mr. Dimon, isn't this bad about tariffs? And his response was, get over it. That's exactly what his response was. Get over it. They're coming, and just deal with them. And so that's part of this acceptance that we're going to see big, bold plans as we move forward.
Okay, so let me address that. Let me just address Jamie Dimon. If there's one sector, and you saw it right away after the election, that benefits the most from what Trump's going to be doing, and of course support in Congress with the Republicans in charge, is deregulation, broad-based deregulation for the big banks. There's nothing Jamie Dimon can possibly say that would be detrimental to Trump, because Trump is great for his business. Capital rules, and so he's going to play ball with Trump. I don't know why anybody cares what Jamie Dimon has to say about tariffs, because it doesn't affect his business. It'd be interesting to see Jamie Dimon said on a panel and debate, the head of the Home Builders Association, the head of the CEOs of the auto industry. So he's talking about how great tariffs are, because as the tariffs turn North American supply chains upside down, it's not going to directly affect Jamie Dimon. So I would say that whatever Jamie Dimon has to say on tariffs would be no more important than what the head of the National Association of Manufacturers would say about financial sector deregulation. In other words, it doesn't matter at all. With respect to Pierre Poilievre and the very high likelihood that we're going to have a conservative government, and Poilievre would be very comfortable in the in the Republican Party in the U.S., and that much is true, and probably would have much better relationship with Trump, no doubt about that. But as we sit right now, the Canadian Parliament is prorogued. We haven't even had a leadership campaign yet run its course. We don't know who's going to run the Liberal Party, and the election hasn't been called. So we could be talking about May or June or July, like who knows. So right now, that's a good 4, 5, maybe 6 months away from the Canadian election. I do agree that Donald Trump had no respect for Justin Trudeau, but he accomplished the job, maybe with him and Chrystia Freeland, who appropriately resigned and with an aggressive letter threw Trudeau under the bus. But I mean, you would have thought if this was all just about Justin Trudeau, mission accomplished. He's done. And yet, Trump, the pendulum's been swinging. Everybody thought that over a week ago he didn't impose tariffs on day one, that people thought he was backing away. And he's going to do something with Colombia, but they acquiesced, and so there's no trade action there. So everybody thought, well, this is all transactional. And then just in the last 48 hours, he's back on the 25% tariff on Canada and Mexico. And the disappointment with all the flag bearers for Scott Bessent, who I understand is brilliant and comes from our industry and is a global macro big picture thinker, he is totally supportive of these tariffs. So I'm actually a little concerned that, I also was at, Jimmy, you and I were there together in LA. It was actually during the fires, where we were told by somebody who's a Republican insider that in Trump 1.0, we were told to take Trump seriously, but not literally. And now the mantra within the Trump team is to take them both seriously and literally. And it could well be that people that say, well, this is all purely transactional, maybe it is with some countries, but he seems to think that Canada, with its own depressed manufacturing base and was affected by globalization at least as much as the U.S., somehow Canada's being tarred and feathered. You had already government officials go to Mar-a-Lago, talk to Trump, beefed up the border, pledged more assistance as far as NATO is concerned. None of that seems to really have moved the needle very much. But the one thing we know for a fact, and we'll know more on February the 1st, is that even with Justin Trudeau's departure, Trump has not really toned down the rhetoric when it comes to what he wants to do with Canada. So I almost look at that right now as irrelevant. There's something else that's prompting him to want to do this. Maybe he's serious about, I'm not saying annexing Canada, but bringing Canada more into American influence and fold. I mean, who knows really what his modus operandi is. But if it was all about Justin Trudeau, Jimmy, he would have backed off by now, because Trudeau was basically yesterday's story at this point.
On the issue of the tariffs, we have Canada and Mexico steel makers now refusing new U.S. orders. And also just the last day or so, Canada calling for a summit of nations that could be adversely affected by the potential effects of the tariffs and what to do about it. Could the U.S. impose tariff backfire and accelerate sort of non-U.S. trade and de-dollarization, enhance BRICS economic activity?
I'm going to chime in on this. I think we need to look at the tariffs in 3 different ways, or the threats of them. One is Trump basically running around with a baseball bat and using tariffs to hit any country on the head that he doesn't like what they're doing. Then he has what he did in 2017, 2018 was to use tariffs to try to both reshore production to the U.S. of things that companies were making elsewhere, and also to defend and entrench and and help domestic production like steel and aluminum to compete against other countries. But now we have the possibility of a third reason for the administration to use taxes, and that's to pay for the extension of the expiring Trump tax cuts. So because of the reconciliation budget rules, Trump needs to find, I think it's $4.6 trillion of so-called offsets. And hopefully, the ideal scenario would he'd find them through spending cuts, but it's possible that he only finds about half of that through spending cuts, and he's going to be relying on tariffs as a piggy bank to fill the gap and say, yeah, we'll tariff this, this, and this, but we'll mitigate it through extending your tax cuts. And if you're in the blue states, we'll raise the cap on your SALT deduction. But that is a more, and similar to what we saw in 2017, 2018, a more scattershot approach to tariffs, which I think is going to backfire, just like it backfired in 2017. I mean, when I talk to people about tariffs, I say, one of the good things about Trump is that we have a body of evidence of the impact of his previous tariffs, because it wasn't long ago that he implemented them. And I asked people, okay, now that we can look back, what's been the benefits? And I can't get any answers of any of the benefits. What we did see was U.S. manufacturing went into recession, and Jay Powell was cutting interest rates in 2019 in response to it. You look at the attempts to defend steel and aluminum industry, well, there were more lost jobs and more damage done to the users of steel and aluminum that had it as an input to their business than there were any benefits to steel and aluminum. So I'm still trying to figure out, and I hear these really smart people tell me about the beauty of tariffs. I think one of the mistakes they make, and I heard a famous hedge fund guy on CNBC said, it's leveling the playing field. I'm like, well, that assumes an all else equal world. And we don't live in that kind of world, as we saw in 2017 and 2018. So this is the one path that I think it's dangerous to go down. And also, it's not really taking into account all the reciprocity that we'll see. And you talked about these international groups, but they're not just going to sit by quietly. And yeah, some of them are going to have to absorb it and some are not. But in the aggregate, it's going to do us, I believe, no good and only will make things worse. And I want to say about Jamie Dimon, who I've been a fan of my entire career, I was pretty disappointed with his comment, because I would love for him to go to a small business that has no choice but to import product from China. And Jamie can tell them, get over it. Get over it that you're going to have to pay 20% more for your raw materials and your production out of China. You'll get a small business that has, 2 stores, or a small business that's making something they're selling to Walmart. And now they may not be able to afford to sell to Walmart because they are going to have to raise prices, and Walmart's going to tell them to screw off because they're not going to accept that product. So I was pretty disappointed with his flippant comment because there are a lot of people in the U.S. that are negatively impacted by these tariffs. That's not going to be fully offset by a strong dollar or other reasons, because on paper, yes, a strong dollar is a good mitigant, but we live in the world of foreign exchange where $7-8 trillion trades a day. Well, what happens if the dollar starts responding to some other factors and the dollar all of a sudden weakens by 10% after a 10% raise in the tariff, and that company at that moment in time needs to get an invoice from their China importer, and their China importer is not going to say to them, hey, don't worry, I'll invoice you at when the exchange rate was this. No, they're going to say, we'll invoice you today with the exchange rate where it is today. So I just think that there are too many unintended consequences that we're not going to be able to control.
Ira, did you want to chime in?
Yeah, I think these are all great points. And, I go back to the Vicente testimony on his confirmation hearing. And I'm with when he's talked about the 2.5% per month the other day, I took that as a disappointment, because to me, the best questions that came that day was from Todd Young, the senator from Indiana, who I really didn't know of before. And the two issues that he asked, which were interesting, were Nippon Steel buying U.S. Steel, which here was a senator from Indiana, and he talked about the $1 billion in investment that Nippon was going to put into Gary, Indiana. So he was really in favor of that deal. And Vicente, he hummed and hawed on his answer because he's not Secretary of Treasury yet, and he didn't want to step on wherever Trump was going. So I think that's a good indicator or barometer what's going to go on. But then Young also asked a very good question. And I think we would probably all agree with it, that in the first administration, let's go back to Trump 1, which we've seen, Peter Navarro, who I have about as much respect for as I do for, I don't know, not high on my list, but because Navarro just threw out these tariff issues. But as Senator Young talked about, the original trade agreement that China made with Trump, with the Trump administration, had a ton of agricultural exports. Now, Todd Young raised the issue that those agreements were never fulfilled whatsoever, in which Vicente talked about, he's going to look at that, and that agreement is very important, especially for American farmers. And again, this is who elected Trump. And if you think you're going to throw on tariffs and everybody's going to sit there and not respond, and I'm not talking about a Smoot-Hawley situation, but what did China do when they did that? They started just buying up everything from Brazil. And we'll get, in the Brazilian real for the world right now, Brazil made all-time lows, the real, and I think it's going to be an important indicator, made all-time lows this month. So if Brazil does bring in a full crop, again, those crops are going to be very sought after from the whole world because the real is cheap against a lot of other currencies. And again, everything will be converted to dollars, so the Brazilian farmers will do very well. But I'm interested to see if Vicente goes more to fulfill that, to placate the heartland of America, which I think is very important. I don't think that this administration, and Vicente said it, and I know everybody hears that, you're not going to turn your back on Main Street. If Trump turns his back on Main Street, I think it'll be a grave mistake for the whole country, because it'll leave a lot of people going, where do I go now? So I think they're looking to sustain that. So these are things that I'm just watching. Rather than tariffs, you made these bilateral agreements, try to fulfill those agreements, because tariffs won't do good, as we've talked about. If the dollar goes higher, all you're going to do is steal growth from the rest of the world, because the amount of dollar-denominated debt, and I know David talks about it, and Jim, we're all aware of it, is huge. So if the dollar goes higher, the debt burden grows. And it's not something that the world really knows, because then the United States will just be borrowing growth from the rest of the world, and it'll come back to haunt, because you are going to have major repercussions for the global debt situation.
Yeah, and speaking of debt, Jim, you mentioned bold initiatives. Given that China and Japan are encouraging their industry to repatriate, selling U.S. Treasury bonds, repatriating that for assisting industry development in their countries. And also we have 1/3 of U.S. debt to be renewed this year with the 36 trillion national debt. Could one of those bold initiatives be leveraging and promoting cryptocurrencies and the digital asset sector? Because the idea is when you buy Tether or a US dollar stablecoin, different types of cryptos, you're effectively buying US Treasury bonds because they need to be backed, right? There's a collateral backing that's required. So will this work, or could this work to help put a bid on US Treasury bonds?
at the margin, and take the second part first, at the margin, an increased demand for stable coins could potentially add to it, assuming that you're going to use a one-for-one backed stablecoin. There are algorithmic stablecoins. There are partially backed stablecoins. There are crypto-backed stablecoins. DAI was the original one, and it's still out there, and it uses other cryptocurrencies to back it. But the vast majority of them are fully one-for-one backed. The problem you're going to have with that is you're going to promote a stablecoin. What does promote a stablecoin mean? I'll tell you what it means. It means taking business away from Citibank, Wells Fargo, B of A, and JP Morgan, and using a stable coin, taking away business from MasterCard and Visa, using a stable coin in lieu of their services. So it's going to be a tough road to hoe to try and push the stable coin idea on everybody. And then you're going to have the regulator stepping in, because these things are not securities, they're not bank loans, they're outside the financial system in an electronic wallet. There is no consumer protections on them. It's not that I'm against them. It's just that is more of a longer tail type of thing. Let me go back to the bold initiatives. Let me just state it up front, just generally what was being discussed. U.S. debt, the U.S. is going to have to restructure its debt. Restructuring its debt, in any restructuring, somebody loses. And the losers are going to be the owners of the U.S. debt, which is largely foreigners. They're probably going to be offered a deal where you take some kind of give us all your treasury bonds. We're going to give you a new treasury bond, probably with a lower interest rate or a zero interest rate. And you're not going to like it, but tough. What are you going to do about it? If you don't, we're going to put 100% tariff on you. I'm not saying I agree with this. I'm just trying to explain the situation. And you could go cut a deal with with the Chinese and with the Russians, and you could become part of their orb, or you could stay as part of our orb. That's really what I think we're headed down towards. Now, will that create dislocations and problems? Sure. But the idea is that if the debt situation, as you pointed out, we've got to refinance a third of it, but we always have to refinance a third of it every year. So that's not necessarily out of line. But if you are worried that there is going to be a debt problem, there's no escaping it. It's somebody has to get screwed. Who is it going to be? And our answer is, in a debt restructuring, cram it down on the Europeans, cram it down on the Japanese and the Chinese, and let them be screwed as opposed to Americans. Will there be blowback on America? Yes. But if you do nothing, there's going to be blowback on America. So that's really what we're talking about with bold initiatives. That, you want to get the debt under control? That's a way to get the debt under control. And it's, you could argue that might actually be a net positive for the U.S. because you've solved a huge problem that it has. Admit that you might have some kind of inflationary blowback or something else. I'm not saying this is what they're going to do. I'll just reiterate what I said before. Don't think that their job. Don't think that they're just looking to deport illegal migrants, take over Greenland and Panama, and play golf for 3 years. They're going to do those three things, and then they're going to start thinking bigger and bigger and bigger. And one of the things they're going to start thinking about is, what do we do about the debt situation? And Trump is very familiar with the idea there has to be a restructuring. And I'll just repeat it. In every restructuring, somebody loses. There is no such thing as a restructuring where everybody wins. Otherwise, we would do it and do it and do it and do it and do it because there'd be no losers. So that's really something that we have to think about when it comes to the debt. You're muted.
Yeah, very interesting comments and views, Jim. And I guess, if we can do one last question, a round of investment ideas, given the environment we're talking about, the risks, the trends, what are your best ideas for investments, generic asset classes that make sense for protection or investing and trading? Maybe start with David.
Okay, I just give me maybe a minute just to respond to what Jim said, because I think Jim is saying we'll just basically screw the Europeans and the Asians, but half the debt is owned internally by U.S. pension funds and insurance companies. and mutual funds. So unless you craft something where you're going to screw foreigners, but not screw American holders of the debt, that is going to be extremely difficult to do.
That's the plan, David. Is exactly the plan. Screw the foreigners.
Yeah, but you can't screw the foreigners and not screw American investors in. How is that going to look? That we're going to basically buy back the debt you own. I mean, it's all one pile of treasuries. Pari passu. I don't think that they could do that. And if they did that, they would have to do that for the entire debt pie. You can't. I don't think that they can actually do what you're saying they're going to do. They could actually restructure the debt, but you can't pick which country you're going to choose to restructure the debt. When a company restructures its debt, it doesn't pick and choose which creditors, it's going to restructure. So that doesn't make any sense to me. And so you're going to screw the pension funds in the United States. You're going to create a revolution. There's people that own treasuries in their 401ks. You're going to screw Americans and foreigners, and I guess you could have a blanket debt restructuring, and that is a default. And then what happens is the U.S. then relinquishes, finally, its reserve currency status. Because you can't be a reserve currency in default on your debt, which is what a restructuring is. And then Bitcoin and the whole crypto space just explodes. Gold explodes. Probably any hard asset is going to absolutely go gangbusters. So if that's your view, I think that's what's going to happen. I think that outside of that, I said before, the only certainty we know is that we are in a new and heightened range. I look at boldness, and I see here what Jimmy says, and this is all experimentation, and that is a more uncertain world. In a more uncertain world, by several multiples of what we've seen in our professional lives, tells you that you should be expecting wider risk premia across all asset classes. And it means you have to be much more selective in your investment process. And I think that you want to seek out the safe havens, wherever they may be within the stock market, and wherever they may be in the bond market. You might be surprised to hear, that, for example, the high yield market, the speculative grade bond market in the United States has never been as high quality as it is today. That might be something you want to look at. Ginnie Mae bond at 5.4% with an implicit guarantee. Not a bad place. I think that we will look back at this year like we did in 2022, where 4 to 5% is going to be an absolute home run. Well, I mean, you can get that in cash today, in treasury bills. No duration risk, no capital risk, and you couldn't get that yield back in 2022. So I think invest around the concept of wider risk premia, safety and income at a reasonable price, and probably, although people think that Warren Buffett is some legendary investor who's lost it, there's just marbles rolling around in his head, but he does have the experience, which is tough to replace in our business, and he's sitting on 30% cash right now, which he's never done before, and this is the world's poster child for, although he's no child, for value investing. So cash right now is not a bad place to be. When you hear Jay Powell talking about walking in the dark for an investor means to de-risk the portfolio, concentrate on safe yield where it exists, and ensure that you have liquidity on hand, and especially since liquidity is paying you a real yield right now. And this will be a year of surviving after 2 years of unremittent capital appreciation across virtually every risk-on asset. I think that we will mean revert this year. So that's my investment thesis. It's called do not fall in love with your portfolio, fall in love with your partner. Your portfolio will not love you back.
Okay. Yeah.
And that's my philosophy.
Great way of putting it. Thanks, David. And your thoughts on investment ideas, Peter?
So the things I like right now in this environment and we've been buying is I really love the oil and gas stocks. $72 oil on inflation-adjusted basis is dirt cheap. And regardless of what happens with DeepSeek and Alibaba and the Chinese attempt to compete against American AI, the natural gas is only going higher. We've recently been buying fertilizer stocks as corn prices have hit a one-year high. I see just flashing by you posted lumber. Bought Weyerhaeuser due to the unfortunate fires in California that week. And also what I find all of a sudden really attractive and really beaten up and providing really nice dividend yields are the food stocks like Nestle, Conagra. We just recently bought Kraft a couple of days ago. In a world that's highly uncertain, they've destroyed these food stocks. And I still know that while there are challenges in their businesses, people are still going to eat every day. And lastly, gold miners are very cheap too relative to the price of gold. So I'm pretty bullish there as well. To name a few.
Great, thanks. Yeah, thanks, Peter. And your thoughts on investment ideas, Jim?
Real quick, David, we can single out who gets paid and doesn't get paid on treasuries. We've done it to Russia twice. We did it in 2014 on the first invasion, and we did it in 2022 to Russia. It's just the world approved of it. But, and again, what I suggested is not my viewpoint. I'm suggesting that they're going to think bold. And the idea of a restructuring is if we do nothing, the world blows up. Maybe we just blow up half the world. That's what a restructuring is all about. And that's really what we're at. In other words, you're saying it's going to screw the American pension holder. Well, if we do nothing, it's going to screw the American pension holder. That would be the mentality behind doing some kind of a bold move like that. And like I said, I'm not suggesting it. I'm just saying people are thinking bold along those lines. Now, to my investment thesis, I think there's going to be a convergence of returns in asset classes. I've referred to this as the 4-5-6 economy, that over the next several years, you're going to get 4% on cash, you get 5% on bonds, you get 6% on stocks. That's not necessarily a bad scenario. I think we've all become very comfortable with this idea that there's supposed to be this, what I'd call a beta tailwind on the stock market. And, something's going to go up 20-25% every year. And I want to know what it is. And I want to buy a passive investment in that asset class and watch it go up 25%. Whether it's gold, it's Bitcoin, it's the stock market, it's the world stock market, or the like. I think that era is coming to an end. Yes, 6%, it's going to be a real return. That's the asset class. Within the asset class, as Peter laid out some great ideas there, you're going to have stocks and ideas and themes that could do much better. You're going to have some that are going to do much worse. So I think really what we're going to do is we're going into the end of the TINA era. TINA, there is no alternative. You have to be in U.S. stocks. You have to be in the Mag 7 because they go up. I think we're going to go into an era of lots of alternatives. Those alternatives will return you more than the inflation rate. You'll get a real return on them over several years. But I don't think that they're going to be these spectacular type of returns that we've seen. And if what we've seen with DeepSeek is going to be any indicative that we're going to squeeze the margins and lower the cost of entry for people to enter AI, then you're going to see it start with those Magnificent Seven stocks struggling. And if they are going to struggle mainly because it's not just going to be them, or as I like to call it, the first row of the inauguration, which was the gatekeepers of AI. But now there's going to be hundreds of potential gatekeepers of AI because you don't have to be like Microsoft and literally sign an agreement to restart a nuclear power plant to get enough energy to power your data center. And yeah, the nuclear power plant that they're signing an agreement with is 3 Mile Island, to restart part of 3 Mile Island so that they can build their data centers around it so they've got enough power. Well, if you don't need that kind of infrastructure for AI, you're going to bring a lot of players into it. And that's going to lower the margins, and that's going to reduce the moat that these companies have. And these are the big 7 companies that have huge expectations that have been powering the stock market higher. I'm not suggesting they're going to go down or go bankrupt or anything like that. They're just going to return to more market normal type of returns. And if they wind up doing that, then I do think that 4, 5, 6 economy is really what we should be looking at. Yeah, the markets will give you returns above the inflation rate, but it's not going to be like we've seen over the last couple of years.
Nice observations. And finally, Ira, your thoughts on
investment ideas? So, I think that in this volatile world, and we all agree, there's just so many things, as I like to put it, if you look at, Mao's famous dictum, it takes a single spark to start a prairie fire, but there's all kinds of stacks of tinder all over the world. And I think we're going to see them all get lit at different times. Now, how will we respond to it? I listen to all these investment opportunities, and we're all cautious. I hear it, and I'm just as cautious. And I hear Peter, I still, we've talked about this for years already, for the last 3 years anyway, ag stocks, and they've been beaten down for several reasons, but I'm looking for them to perform better, and all the ones that go with them. And in saying that, one of the things that I'm watching here, I brought it up before, the Brazilian real is a very interesting currency here, because a currency that made all-time lows this month, but may close above it's December's high. I'm talking about the real. So that for technicians is that's what they would typically call a key outside reversal. Now the month isn't over yet, and we're very much into those areas. But if that happens, then it's telling me that maybe the emerging markets get very interesting here, because I saw what the real and the peso did on Monday following, Trump's weekend in Cartagena with the Colombians, and they really didn't get beat up. And I really thought that they would wind up getting beat up a lot more. They didn't. So we're coming into month end. I don't know where this is totally going to go. Interestingly, we're left with Scott Bessent, and the only Brazil becomes really interesting to me, because the only one we've seen like Bessent was Arminio Fraga, who came out of the Soros group, and Druckenmiller. Druckenmiller is, to me, a significant variable here, because he's a good person to learn under on how to deal with, flashpoints in the global economy, because they're practitioners, not just theoreticians. What a refreshing idea that is. So I'm looking for that. I'm looking for that to play out. So I'm watching that. But then grains, as Peter talked about, I'm watching them very carefully, because if Bessent pushes, rather than tariffs, to have these bilateral trade agreements fulfilled and realized, then we're going to see a lot of different things. Again, are we going to be early to this? Yeah, typically I'm early, and that can be painful. I'm trying not to be early, so I'm really holding my water. And what David said about Buffett, I think, is very important. And you can make fun of Buffett all you want, but I'd like to have the gains that he made in Japan when he started investing in Japan in 2020 and 2021 in the middle of COVID, when he started buying Japanese trading companies. He's done phenomenally well. So again, I'm looking at foreign banks, and the banks that I've talked about, with David before and with Peter, and not so much Jim, but I still love Tokyo Mitsubishi. I love some of the European banks, and that's so hard for me to say, because Europe is such a mess. If you really want to see a mess, Europe is a mess. But will Lagarde use this to get what she wants, which is a capital markets union? If Europe could actually, after they get through the German elections, which are not going to be a walk in the park, and then you got the French, of course. But if the Europeans could create a capital markets union, I think it'll change a lot of the things around the globe. I mean, the fact that they did this ass backwards, creating the euro before they created a bond and a banking union and tax harmonization was probably, and as Bernard Connolly has written about it for over 30 years, it just was a disaster. Now they're trying to come at it through the back door. So that's another one. Will Trump get a ceasefire in Ukraine? I think yes. The Mideast, I think, is going to be a different story, but I think he's serious. And where will that lead? I don't know. And as David talked about, what's the Canadian elections going to play out? Again, all these things are in play, but I think that there are real asset classes out there that you can look at. And I'm not telling you to jump into anything, because you do damn well better figure out what your risk factor is before you do any of this. Because there's, as we just saw this Monday again, right? You want a lot of risk? NVIDIA losing 700 billion of value. Is that enough? You know, it's like going back to March of 2023, when we saw Silicon Valley Bank disappear, vaporize. We saw First Republic, which was a darling of the investment world of, you know, people who invest in banks, basically disappear. So you better really understand where you are risk of world. And me, I love good returns with low with low volatility. That's what I strive for, and I think that's what everybody should strive for. I mean, we all love to ride NVIDIA and other AI stocks, but there's plenty of good opportunities, and that's where I'm looking at more of the stalwarts of the global growth, because I think Trump wants growth, and global growth is important. And again, is that going to come with a weaker dollar? I think that's going to be a big theme going forward. But again, we haven't heard a word from Bissent. You know, everybody thinks they know what Scott Bissent's going to do. I have no idea, but I know it will be creative.
Just nominated yesterday. Yeah, those are great ideas, Ira. And if we can do one more round, just final thoughts, and how can our listeners and viewers learn more about your work, David?
Sure. Just either Google information at rosenbergresearch.com, and you can sign up for a 1-month free trial, and one of my client service representatives will help you get registered. You can also just Google Rosenberg Research, surf the web, see what I do. There's all sorts of samples of research, and there's also a way to register on the website. And those are the two best ways to kick my tires.
Thank you, David. And Peter? Peter, go ahead. Yeah.
So to see my daily writings, you can go to Substack and type in my name. And on the wealth management side, you can learn about us at bleakley.com.
Thanks, Peter. And Jim?
BiancoResearch.com is our research business. I'm also active on social media at Bianco Research on X, on YouTube, Jim Bianco on LinkedIn. We also have a ETF. You can find out more about that. It's a total return fixed income ETF. It's BiancoAdvisors.com, which is where you can find out about the ETF, and its symbol is WTBN.
Thanks, Jim. And Ira?
Thanks.
Well, most of the time you can find me when I do the podcast with you, Richard, on FRA. I'm not really, I don't blog anymore. I miss it, but, and again, let me tell you, it's such a great honor for me to sit with you three and Richard to host this, because really, you know, there's people, I'm living in a community where there's a lot of retired successful people, and they're fans of all three of you. You know, I could have sold tickets up here in my office to sit and listen to this live. I said, yeah, you know what, but this is really a great pleasure for me, and to be able to traverse, really, we traverse the world and look at it, and it's going to be a tough world. But I would add one thing where I didn't say before. One of the areas, and I've lost money in it in venture capital ways, but I think blockchain going forward, because when you talk about stable coin and the ability to really, if you're going to harm Wall Street, all you do is have to go after their fee. And if you can get to a blockchain system where we can all cut our fees for what the banks take out of the game, it'll be worth doing. I think they've been blocking it, but at some point, somebody with enough money is going to elevate blockchain to a real secure type of financial transaction, and that'll really cut costs. So I don't know enough about it yet. I thought I did, but I'm learning more. But it is something to watch.
Thank you very much, David, Peter, Jim, and Ira. Thank you so much for the insightful discussion.
Thanks, everyone.
Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.